No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. You know, it's been a rocky week and a rocky quarter as far as that goes in terms of the stock market. So one of the things I want to talk about to start off today is a little bit about the markets, put in perspective exactly what's going on, and more importantly, what this might mean and some strategies you can employ. One of the things to understand too is we're going to talk about how it differs when you're saving for retirement or investing pre-retirement, and then when you're investing in retirement, how that needs to change. This has to do with sequence of returns risk, and this can be the difference between, as Tony Robbins put it, being a happy camper or a homeless camper. All right, this has to do with the possibility of running out of money being greatly increased in retirement if you don't have your asset allocation done correctly and have defensive strategies against market downturns. And so when we're looking at today, the market over the last quarter, so it's high, if you will, at around the end of September to today, is down about let's see, 8% on the year, or excuse me, 8% since that period. So basically, over the course of not quite the full quarter, we've seen an 8% drop in the market. Now, to put in perspective, though, if we look at the beginning of the year and we look at the year-to-date numbers, we're almost dead even. It's like zero return. The market, it was 26.95, the S&P at the beginning of the year, and then yesterday at the market close it was 26.95. So, and today we'll see what the market does in terms of the new jobs report and the rest of that. More likely for a positive day than a negative day, but there's so many different factors at play here. The most important thing is these day-to-day movements is not to get too concerned about this, not to read into it too much. We've seen that Federal Reserve now is talking more softening of their approach, and this has to do with the numbers, including the jobs report number will feed into that as well. So as they see inflation concerns with the economy or the job market and everything slowing down a bit, then they're going to be thinking, okay, well, we don't have to worry about inflation, therefore we don't have to raise rates as much as a countermeasure. In fact, we want to be careful not to raise rates too much, which could have the opposite effect and lead maybe to deflation. So one of the things when you're looking at the markets today is not to get too concerned about these short-term movements. We certainly are not looking at a recession with the economy as strong as it is. So that would be unprecedented. However, that doesn't mean that what we do want to do, in fact, what we don't want to get complacent. The most important piece is to look at, this is a great opportunity to look at your current portfolio. How is it matching up compared to the market? It's, as I mentioned, it's dropped 8% from the market highs. How has your portfolio done over that same period? Has it dropped more than 8%, less than 8%? And now we're looking at, if you're in comparison, let's say that you've got a portfolio that's 50-50 stocks to bonds. Then the expectation, right, when we're comparing the stock market, which the S&P 500 index, 100% stocks, if you've got a 50-50 portfolio, the expectation would be that you would lose less than half. In other words, you should be down only around 4% or less on your portfolio over that same period. If your asset allocation model, right, is doing as well as the S&P 500 index. So what do we know? The S&P 500 index, 500 largest companies in the United States, make up 70% of the money in the stock market and outperform 90% of equity mutual funds in the marketplace. So if you're doing as well as the S&P, then you're outperforming 90% of the mutual funds out there in your portfolio. So this is a good thing. Okay, if you're not, this is a good time to take another look at that. I've talked about asset allocation many times. We're looking at 60 years of Nobel Prize winning academic research showing us how to construct a portfolio, showing us how to do that. And I'm going to show you later in the show how the S&P 500 index compares with some of these model portfolios and what that would look like when we use these academic models that we have. So the model portfolios. Now, when we're looking then at this and we're saying at this period in time, the importance of understanding how these models work, it can be a huge difference for you in terms of protecting yourself against downturns, as well as giving you upside, okay, that's still comparable to the market, depending on that equity to bond ratio that you're going to have in your portfolio. Now, there's a number of factors that go into that. One of the things that we talk about is how to do up a plan, all right, to understand what is the needed rate of return on your investments to attain and maintain your standard of living and quality of life no matter how long you live. Do you know that number? Okay, so it's not about how much money you have, it's about how much you're earning. So when we're looking at everything, actually, we're talking about what do you have for income, pre-retirement and in retirement. What are you going to have for expenses? Are they going to change? Okay, if they're in, pre-retirement and in retirement. How about assets? What do you have there? And liabilities, of course, any debt that needs to be paid off. All of these are a part of developing a comprehensive financial plan. And this is one of the things I do with my clients. Of course, all my clients are going to have a comprehensive financial plan. That's the way we start. Okay, and in fact, if you would like an opportunity to see what that would look like for you, a personalized plan, just be one of the first 10 callers. We'll throw it out there this week. For the first 10 callers to my office, 615-376-5325. Tess is standing by to get your information. She'll send you out a packet of things you'll need to bring to your appointment with me so that we can do up a comprehensive financial plan. And what we're going to look at is we'll look at your investment portfolio currently, whether it's 401ks, IRAs, or non-qualified funds, just stocks, bonds, mutual funds, whatever it might be. We'll do an analysis for you. We'll show you, based on the things you're doing over the last 1, 3, 5, 10 years, what your returns would have been, and what your what your risk is, your volatility measure, so that we can see, in relative to the market, if we know that over the last 2 bear markets we've had drops of 45 and 55%, how would your portfolio have fared during that time? Would it have dropped as much, more, less? And how does it compare to the model portfolios I mentioned? And I'll show you more numbers on those later in the show as well. So again, first 10 callers, 615-376-5325. And in addition, when you call and to schedule your appointment to come in with me, one of the things I'm going to do there is I'll also get into talking about Social Security, how to minimize taxes on Social Security, how to minimize taxes on your investments, on your 401ks when you start taking money out. We'll talk about Medicare and how that works in your health care costs in retirement. We get into so many different things, estate planning, tax planning, all of that's on the table. And if you like, I can have people like Dr. Friday come in if you need someone to help with taxes. If you've got someone, then we'll work with them. If you need an estate planning attorney, we've got a couple of great ones that have been here on the show many times. Russ Cook is one, and Jack McCann another. So according to what your needs are, we can provide you everything you need to develop this comprehensive plan for your family, again, to make sure you can attain and maintain your standard of living and quality of life no matter how long you live. And even, we get into other risks like, besides the sequence of returns risk, how to combat that, defensive strategies and hedging strategies to protect you against market downturns, long-term care issues, all of that's covered in this comprehensive plan. So again, be one of the first 10 callers, 615-376-5325. Tessa's standing by. She'll get your information and send you out the packet and a list of things to bring to your appointment with me. Okay, going back to the markets, one of the things to understand with the market, again, break even. If you look at the last 10 years, in other words, we're in the longest bull market in history, okay? So and averaged over 12% a year over this 10-year period, including this, that's year to date, including this year, 2018. So what have we seen? We've seen a few break-even years, and we've seen some really big years, and there's the average. And that's one of the things with the market. 1 in 4 years on average are going to be negative years, all right? But we still can get great averages in return. But we're going to talk later about how these things work. And to put in perspective, sometimes we can get complacent, sometimes we can get overly optimistic when we have such a long bull market. In the 80s and 90s, we saw that as well. And then we had that period of 2000 through 2009 where we actually had a negative, the lost decade, where it was a negative return. So understanding how these things work right? Giving the proper perspective, setting the proper expectations, but also making sure that your asset allocation model in your portfolio is done correctly. You know, when you get that 401k statement and you get the information about which funds that you can invest in, and you're probably looking down and saying, well, this is how this one's done in the past, and this is how this one, and that's some help, right, to a point, but it's just that. It's not helping you in terms of how to put that together, which ones need to go together, and in what percentages to get you not only the best return, but to protect you, again, against market downturns. When you get into retirement, this is going to be even more important. Okay, one of the things there, in fact, I'll show you, we start, when we're doing comprehensive planning, one of the things I do is I start here. I start with a roadmap. Okay, now this roadmap, we'll show it on the screen. This is basically just a foundational thing to kind of organize your funds. So we start out with this lifestyle expense worksheet that we'll send out to you. You fill that out, and the expense worksheet is just to identify what your monthly expenses are. How much does it cost per month to maintain your standard of living? And we don't want you, and this isn't about, oh, I can get by on, or I can get, if I wanted to, I could only spend this much. It's not about that. It's what actual lifestyle you enjoy and want to at least maintain and maybe even increase. That's the number we want to identify. And let's say that's, whether that's $5,000 a month or $10,000 a month, then in your checking account, if it's 5, you want to have a $5,000 rolling balance in your checkbook. If it's 10, you want to have a $10,000 rolling balance in your checkbook. And then you want an emergency fund. And that emergency fund, we don't know what's going to go wrong, but something always does, right? Car breaks down, something with the house, whatever it might be. So what do? Well, we want to have about 6 times that monthly expense. So again, if it's $5,000 a month, you want to have $30,000 in there. If it's $10,000 a month, you want to have $60,000 in your emergency fund. Then the next step down is what we call short-term fund. Now this is more planned expenses. So think of it like this. If my car breaks down, I need to use my emergency fund to get that fixed. If, on the other hand, in 3 years I'm thinking I'm going to replace my car, that's my short-term fund. I want to have money set aside for that. Whatever that expense might be, I don't want that invested in the market be down, and me needing to pull money out that could cause me to experience losses that I wouldn't want to experience. So what I do there, we use short-term strategies for a short-term fund. So monies, whether it's to replace a vehicle or a major home remodel, or maybe one of those, cruise around the world kind of thing, whatever it might be that's outside of the normal year-to-year stuff, that's what goes in a short-term fund. And then finally, your long-term fund. And that long-term fund is where we're going to have the IRAs, 401ks, all your investments, stocks, bonds, mutual funds, all of that. Now keep in mind, when you're looking at the roadmap, notice there towards the right of these numbers, you've got rates of return, and averages over time have shown, for instance, checking and savings aren't going to pay you anything. Money markets are times when they'll be paying over 1%. If you're looking at the short-term fund, you might have things like, besides money markets, you may have short-term CDs, short-term fixed annuities, and these will get you a little extra earnings around 2. But you notice that all those first 3 are not going to stay ahead of inflation and taxes. Long-term fund, 4 to 9% a year, that's what we're looking to average there. And depending on the portfolio, a number of factors as to what that's going to look like. And that's where we're going to pull income in retirement when the wages go away. All right, we're going to take a break. When we come back, I'm going to take up from here again. I want to go in a little more detail, and I'm going to show you how to structure that for yourself, all right? But first, we're going to take a break. Join us here. We'll be right back on the Retirement Report.